Graham used the example of Mr. Market, which is and we've used it. I've copied it in the report. I copy from all the good writers. And Ben said, just imagine that when you buy a stock that in effect, you bought into a business where you have this obliging partner who comes around every day and offers you a price at which you'll either buy or sell, and the price is identical. And no one ever gets that in a private business where daily you get a buy-sell offer by a party. But in the stock market, you get it. That's a huge advantage. And it's a bigger advantage if this partner of yours is a heavy drinking manic depressive. I mean, the crazier he is, the more money you're going to make. So you should, as an investor, you love volatility. Not if you're on margin. But if you're an investor, you aren't on margin. And if you're an investor, you love the idea of wild swings because it means more things are going to get mispriced.
So I think one of the key concepts of value investing that's definitely underpins everything else is the idea of Mr. Market. Now, Mr. Market is basically a character that Benjamin Graham came up with back in 1949 in The Intelligent Investor. That basically describes the irrationalities of the stock market. So it's a character that has mood swings from fear to greed constantly, which describes the whole market as a whole. But it's designed to be quite interesting and quite easy to understand, and he dulls it down into a personality of a person, and it makes it really easy to actually understand. Now, The Intelligent Investor itself, the book, is a book that Warren Buffett's been very famously said that is by far, in his opinion, the best book on investing that's ever been written. It's Benjamin Graham's actually his professor back at Columbia Business School that taught him the very basics that has made him who he is now. It's taught him all the fundamentals of, well, they call it nets. So basically buying really cheap, like cigar but investments. But he's the one who actually taught Warren Buffett. Now, also one of the other key concepts that Mr. Market shows, it obviously shows the fluctuations in the market, but it also shows that that price and value are not the same thing. And this is a very, very, very key, if not one of the most key ideas that's actually in value investing that we've got to understand. So probably the easiest way of describing who Mr. Market is by actually describing his character. So like how Benjamin Graham sort of it describes him. So probably the easiest way of describing him is describing him as like your next door neighbour. So imagine you've got a next door neighbour, and your next door neighbour goes through days of being really optimistic and then really pessimistic. Yeah, and some days he will come to the garden, shout over the fence to you, and say that he wants to buy your house for £500,000. And then the next day he'll think the whole world's falling around him, and he'll only offer you £100,000 for your house. Now, both of them times you'd probably just go, no, I'll keep my house. Yeah, but the idea is that he'll throw obscene numbers at you all the time. Some days they will be around the price you think your house is worth. Some days they'll be way more. Some days they'll be far less. But the idea is you wouldn't sell your house, yeah, unless it got to such an obscene value that he was throwing at you. Say you think your house is worth £400,000 and he's shouting £800,000, then you might contemplate it. But the idea is it's the same with the stock market. Every single day you're given a price that is the price of your stock. It's not the value of your stock; it's the price that is being offered in that day. Now you can think about price and value as two different things. So the price is just what they're offering you. Like this next door neighbour is coming every day, and the day that he's really optimistic, he might offer you £600,000. The next day he might only offer you £100,000. Now you wouldn't just sell because he's offered you £100,000 for your house. It doesn't mean you would sell, because you know full well it's worth more than that. So that's the idea that what we've got to get to when we're doing our stock market investing. You've got to look at a stock not as just a piece of paper or a chart on your phone, but as an actual underlying company. And then you need to evaluate that company, work out, like I've spoken about in the previous video, the actual cash flows that come from that company and how much you think the intrinsic or the true value of that business is. You then can obviously decide, when you're getting thrown stock quotes, prices every single day at you, you can decide whether you want to, if it is really cheap, if they're offering to sell stock to you for, let's say, Apple for $10 a share and you think it's worth $20 a share, well, that's a 50% what we call a margin of safety. So it's a 50% discount to what you think the actual value, not the price, but the value of that stock is. And then that way you'd go, actually, I'll probably buy more today. And the whole idea of buying low and selling high is what we want to try and do. But actually, in the stock market, because of our irrational and the emotions behind everything, and because that is what runs most of the stock market, is people's emotions. They let their emotions take over, and then they end up actually selling low and buying high. That ends up with what's happening. One of the easiest ways of actually thinking about this is if you, like I've spoken about in the previous video, when coming up for a value of a company, you think of you actually owning the whole company. Now, if you think of it even in a more simpler way, is like if you started a company, just a private company, and someone came to you and you got proper people that came and valued your business, and they say your business is worth £100,000. Now, the next day, you have a man that comes up to you and goes, I want to buy it for £50,000. Just because that person has come to you and said they want to pay, they think it's worth £50,000, doesn't mean it actually is worth £50,000. And you wouldn't sell it to him out of fear that actually that it's just going to keep going down. Because you know the true underlying value of your company that you own is £100,000. So that's how we have to think about it in the stock market, because you are buying a piece of a company, maybe a very, very small slither of a company, but you are buying part of a company. So that's how you've got to think about it. Now, you might be thinking, what's actually the reason for why the stock market is so irrational, and it goes back and forth, back and forth. And we've obviously said about emotions, but also because a lot of institutional investors, so these are people that work in big firms like Goldman Sachs or BlackRock or big investment firms, a lot of them are looking out to the next 3 months, the next quarter. Whereas one of our biggest advantages as little investors is that we can look and go, actually, we'll look for the next 5 or 10 years. We're looking to the long term, because in the short term, no one can predict anything in the stock market or in any companies. Actually, 5 and 10 years is far easier. Now, it's not guaranteed. No one knows what's going to happen in 10 years, but you can have a much greater idea of what the general thesis of that company is in the next 10 years. What you think it's going to look like in 10 years or 5 years is far easier than looking for the next 3 months, because the next 3 months can be swayed by loads of things like geopolitical issues, short-term issues with the stock, in terms of the actual company itself. You can come up with a lot of issues in the next 3 months, and that's why a lot of institutional investors invest for the next 3 months and come up with predictions on what they think the stock's going to do in 3 months, but actually no one really knows. And there's a very famous saying that in the long term, the stock market is a weighing machine. In the short term, it's a voting machine. So in the short term, it's like everyone's just voting whether they think the stock's going to go up quickly or down. But actually, in the long term, the underlying value of the company will track the stock price. And actually, if you think you've bought it for let's say $50 a share, and you think it's worth 100. Well, actually, over 10 years, it probably will track up to the 100, if not more, if the company's growing. Because over the long term, the value will track the rough stock. So one of the other reasons why the stock market has quite a short-term outlook is because of something called the efficient market hypothesis that was actually created by Eugene Fama. He actually got a Nobel Prize in this, and the idea is that basically all stock prices actually represent the true value of the company, because the idea is that all information is all available to everyone, and all information is actually baked into the actual price of the stock, and therefore the price actually equals the value. But we know this isn't correct, because you can think about some short-term issues that people have taken and the stock price is dumped, but actually isn't affecting the long-term underlying business itself. So one of the key examples we can look at that just proves that the efficient market hypothesis isn't actually true is Chipotle Mexican Grill. This is a key example because it was a short-term issue that they came across in 2018-2019 that actually hasn't affected the long-term prospects of the company. Now, don't get me wrong, it could have if they didn't fix the issue that I'm about to describe to you, but it was quite obvious at the time that they actually were going to fix this issue and they were going to get on top of it. And don't get me wrong, like the customer's sentiment with the company did decline over the next 18 months, and they have had to work very hard to sort of gain that trust back, but they were clearly had a competitive advantage that allowed them to actually gain these customers back. So in about 2018-2019, we had an E. coli scare, and this meant obviously people lost a lot of trust with the brand. Now they then ended up turning this round, and they are now probably one of the leading companies in the industry that in terms of like health and safety and food hygiene within the kitchens. So this just proves actually this very short-term issue that the stock absolutely tanked, because all of these institutional investors that were looking out for the next 3 months could see that actually the stock wasn't going to perform as well as they thought in the next 3 months. So they end up selling out, and then actually what happens is the stock goes way below its intrinsic value, and then you can go and pick it up for a discount, and then over the long term it actually ends up being really well, because we have an advantage of looking out to the next 10 years instead of actually just looking at the next 3 months. So the reason why I used the example of Chipotle Mexican Grill was just to prove actually that a short-term issue, that an E. coli scare, which to be honest a lot of businesses can come into these sort of issues, these short-term issues, that actually yes it could have affected the long term, but it was quite obvious from the management's talks and everything else that actually they were really keen on trying to make sure that they got on top of this, and actually they ended up becoming the leading company within the area of food hygiene. Now you couldn't have predicted that, but you could have a good idea from your thorough understanding of the business that you need before you've even invested. Yeah, that they can turn this around, and you look for the 5 or 10 year instead of the 3 months, which is what institutional investors are looking at. You can see that actually this company is going to be worth more in the long term, but actually the price declined so much that it was factoring in basically no growth, and they were factoring for like a doomsday scenario. And actually, if you looked at it, you would think actually it's definitely going to be worth more than this in the future. So hopefully, this just proves actually that efficient market hypothesis isn't real at all. It doesn't actually happen, because even though certain information is baked in, there's no way. People are so emotional and there's so much greed and everything that actually that's never going to be rational. Emotions are never rational. Yeah, this is why we have to try and keep ourselves really rational. But if you've enjoyed this video, hopefully it will help you sort of come to more conclusions when you're doing your own investing, make yourself more rational, and help you look at investments on a more sort of holistic view, and obviously make sure that you're making good investments instead of poor ones. So if you've liked this content, please drop me a like and please subscribe, and also drop a comment down below telling me what other sort of content that you'd like, and I'll see you on the next video. Bye.